Two guys, same city, same salary, same $50,000 in the bank. One of them is about to buy a rental property. The other is about to do absolutely nothing. And somehow, that might be the smarter move. But here's the part that nobody talks about. After 20 years, they're both going to be close to $500,000 in net worth. And one of them is going to be furious about how he got there. Here is what the YouTube thumbnails, the real estate meetups, and your landlord friend at every barbecue will never tell you. The gap between these two outcomes isn't in the asset class. It's in everything you forgot to count. Meet Ryan and Devon. Same starting point in every way that matters. They both earn $55,000 a year. They both have $50,000 saved. Same age, same city, same financial baseline. The only fork in the road is what they do with that money. Ryan takes his $50,000 and uses it as a 20% down payment on a $250,000 rental property, a modest 3-bedroom in a decent neighborhood. He locks in a 30-year mortgage at 7%. His monthly mortgage payment comes out to about $1,330. He finds a tenant willing to pay $1,800 a month. On paper, that's $470 a month in profit before he spent a single dollar on anything else. Ryan feels like a genius. Devon takes the same $50,000 and drops it into a total stock market index fund. No leverage, no tenants, no keys to hand over. He sets up an automatic monthly contribution of $300 and doesn't think about it again. His coworkers ask what he's investing in. He says index funds. They nod politely and change the subject. Nobody's impressed. On day one, Ryan has a house, a tenant, and a story to tell. Devon has a brokerage account and a confirmation email. It's not even close in terms of how it feels. But feelings and math are two very different things. And over the next 2 decades, the math is going to reveal something that should make every new investor stop and read the fine print. For the first few years, Ryan is living the landlord dream. Rent checks hit his account on the first of every month. He drives past his property on the way to work and thinks, I own that. He's claiming mortgage interest and depreciation on his taxes, shaving a couple thousand off his tax bill each year. He's building equity with every mortgage payment. He's watching comparable homes in his neighborhood tick up in value. Everything about this investment feels real, tangible, and smart. Devon, on the other hand, logs into his brokerage account once a quarter, sees the number go up a little, then down a little, then up a little more. Year 1, his $50,000 grows to around $55,000. Year 2, maybe $61,000. It doesn't feel like anything is happening. There's no key in his pocket, no tenant texting him, no asset he can point to from the car window, just a number on a screen. Ryan's friends ask about the property. Devon's friends don't ask about anything. The social proof alone makes Ryan feel like he's winning by a mile. Now let's actually look at the numbers through year 3. Ryan has collected roughly $64,800 in rent. His mortgage payments total about $47,880. That leaves $16,920 in gross cash flow. Sounds great, until you subtract everything else. Property taxes run about $3,000 a year. Insurance adds another $1,500. He's already replaced a water heater for $1,200, fixed a leaking roof for $2,800, and dealt with 1 month of vacancy between tenants that cost him $1,800 in lost rent, plus $600 to clean and relist. Property management? Ryan handles it himself to save money. But that means phone calls at 10 at night, weekend showings, and coordinating repairs on his lunch break. After all real costs, Ryan's actual net cash flow over 3 years is somewhere between $2,000 and $4,000, not the $16,000 that looked so good on a napkin. And that doesn't account for a single hour of his time. Here's the number that should make any aspiring landlord stop cold. Industry data shows a self-managing landlord with a single property will spend somewhere between 50 and 70 hours per year just on the recurring tasks: tenant communication, maintenance coordination, bookkeeping, showings, and turnovers. At an average American wage of roughly $30 an hour, that's $1,500 to $2,000 a year in pure opportunity cost, time that could have been spent on a side skill, a second income stream, or simply your life. Devon, meanwhile, has contributed $50,000 upfront plus $10,800 in monthly contributions. At roughly 10% average annual return, his portfolio is sitting at about $76,000. He spent 0 hours managing it, 0 phone calls, 0 emergencies. But Ryan still has something Devon doesn't, and it's the most powerful force in real estate investing. His $250,000 property has appreciated roughly 3 to 4% a year and is now worth somewhere around $270,000 to $280,000. His equity, the gap between what the home is worth and what he still owes, has grown to roughly $55,000 to $65,000. That's real wealth, and it came partly from using the bank's money. He put in $50,000 and controls a $250,000 asset. That's 5 to 1 leverage, and it is the single advantage stock investors simply cannot replicate. Now, here is the number everyone talks about at the barbecue, the rent check. It's the number on the YouTube thumbnail. What nobody talks about is everything that leaves before you actually keep any of it. Vacancy. The average rental property sits empty about 1 month per year. That's a full mortgage payment with 0 income to offset it. Maintenance and repairs. The standard rule is to budget 1 to 2% of the property's value annually. On a $250,000 home, that's $2,500 to $5,000 per year. Some years it's a $200 faucet fix. Other years it's a $7,000 HVAC replacement that hits in August and cannot wait.
Then there are capital expenditures, the costs everyone forgets until they arrive. Roofs last 20 to 25 years. Furnaces last 15 to 20. Water heaters last 10 to 12. These are guaranteed future costs, and they land in chunks of $5,000 to $15,000. If you're not setting aside money every month for these, you are not running a business. You are running on luck. And then there is the risk no one likes to say out loud. A tenant who knows the eviction process can stop paying rent and remain in the property for 3 to 6 months. That single event can erase an entire year of profit, plus legal fees. None of this shows up in the $470 monthly cash flow number, but it shows up eventually. By year 5, Ryan is deep in the reality of being a landlord. He's on his 3rd tenant. He's replaced the roof for $8,500, dealt with a plumbing emergency for $1,400, and spent 1 month with the property empty. He's raised rent to $1,950, which helps, but property taxes and insurance have crept up too. His actual cash-on-cash return, the money he pockets relative to the money he put in, is hovering around 3 to 5% after real expenses. Not bad, but not the 15 to 20% he was describing at dinner 6 months ago. Devon is still doing absolutely nothing. His portfolio has grown from $50,000 to roughly $135,000 to $150,000 by year 7, including his monthly contributions. He didn't pick individual stocks, he didn't time the market, he didn't do anything except not touch it. And here is where the story starts to quietly shift. The compound growth is beginning to accelerate. The gains on his gains are now generating more new wealth each year than his original contributions ever did. This is what compounding actually looks like. Boring for the first 5 years, astonishing for the next 15. By year 10, Ryan's property is worth roughly $166,000 to $184,000. His remaining mortgage balance sits around $166,000. That puts his equity at approximately $170,000 to $184,000. Over that decade, after subtracting every real cost, mortgage interest, taxes, insurance, repairs, vacancy, capital expenditures, Ryan's total out-of-pocket beyond the original down payment has been somewhere between $20,000 and $35,000. Devon's portfolio, with consistent monthly contributions and historical 10% average annual market returns, is sitting at approximately $165,000 to $180,000. He put in $50,000 up front plus $36,000 in contributions, $86,000 total. The rest is pure compounding, and he spent 0 weekends fixing anything. At year 10, they are surprisingly close in total wealth. Ryan might be slightly ahead thanks to leverage, but here's what the headline number hides. Ryan also spent hundreds of hours managing his property, took on hundreds of thousands of dollars in concentrated debt, and placed his entire investment in a single asset in a single zip code. Devon spread his money across thousands of companies, across dozens of industries globally,
and never lost a single night of sleep over it. That difference in stress, concentration, and liquidity doesn't show up in any net worth calculation, but it shows up in your life. This is where the gap finally opens wide. By year 20, Ryan's property is worth roughly $450,000 to $500,000. His mortgage is either paid off or nearly there. After 20 years of maintenance, repairs, tenant turnover, property taxes, insurance, and at least one significant renovation, his total net profit from cash flow, the actual money he banked above what he spent, might come to $40,000 to $80,000. Maybe more in a strong market, maybe less in a flat one.
Devon's portfolio at 10% average annual return with $300 monthly contributions has grown his original $50,000 to approximately $420,000 to $460,000. Total contributions over 20 years, $122,000. The other $300,000 plus is pure compounding. No debt, no tenants, no 2 a.m. phone calls about a broken pipe. When you compare net worth, they end up in roughly the same ballpark, somewhere between $400,000 and $500,000 each. But the path to get there is completely different. Ryan worked for his. Devon waited for his. Now, here is the new insight that changes the entire conversation, and it's the one most personal finance creators skip entirely. A major 30-year study found that a person who invested $153,000 into the S&P 500 in 1995 would have seen that money grow to more than $3.4 million by the end of 2024. The same amount placed into real estate over those 30 years would have grown to roughly $500,000. That is not a typo. Stocks outperformed real estate by nearly 7 times over 3 decades in that analysis. But here is the critical footnote. That comparison assumes no leverage on the real estate side. The moment you factor in Ryan's 5-to-1 leverage, the gap narrows dramatically. The leverage is real, it matters, and it is the entire reason real estate still creates as many millionaires as it does. But here's the second insight that flips everything again, and this one is about what Devon can do that Ryan cannot. If Devon simply increases his monthly contribution by $200 more, bringing it to $500 a month instead of $300, his 20-year portfolio jumps to somewhere between $550,000 and $600,000. That's because in the stock market, increasing your contribution has a multiplied compounding effect. In real estate, increasing your investment usually means buying another property, taking on another mortgage, and doubling your workload. Scaling in stocks costs Devon nothing but a login. Scaling in real estate costs Ryan everything but a commute. And that's before you factor in what Ryan's hours are actually worth. Over 20 years, if Ryan spent even 5 hours a month on his property, well below what the data suggests for an active, self-managing landlord, and you value that time conservatively at $25 an hour, he's invested an additional $30,000 of his own time into that asset. That time has a cost, even when it doesn't appear on any spreadsheet. If you only heard the downsides of real estate, you'd be getting the same selective picture that stock market influencers give you, just reversed. So let's be honest about what stocks get wrong too. Volatility is genuinely brutal. In 2008, the market dropped roughly 37%. In March of 2020, it fell 34% in a single month. If Devon had $150,000 in his portfolio and watched it fall to $95,000 in a few weeks, that is not just a number on a screen. That is gut-wrenching. And the data is painfully clear on what most people actually do in that moment. They sell at the bottom and buy back in after the recovery, locking in every dollar of loss at exactly the worst time. There's no cash flow either. Unlike a rental property, index funds don't send you a check on the first of the month. Dividends exist, but on a total market fund, you're looking at roughly 1.5% to 2% yield. On $150,000, that's about $200 a month. That is not replacing anyone's income. And there is no leverage. Devon used $50,000 to control $50,000. Ryan used $50,000 to control $250,000. That 5-to-1 ratio is the engine behind most real estate wealth stories, and it's something the stock market simply does not offer without margin accounts carrying their own serious risks. There was also no depreciation deduction in the stock market.
real estate investors can deduct the theoretical decline in a building's value from their taxable income, even when the property is actually appreciating. That's a legal tax shelter Devon simply cannot access. And strategies like 1031 exchanges, which allow you to roll profits from one property into another while deferring capital gains taxes indefinitely, have no equivalent in a standard brokerage account.
Real estate wins clearly in specific, identifiable situations. If the rent-to-price ratio in your market is strong, meaning monthly rent is at least 0.8 to 1% of the purchase price, the cash flow math works from day one. If you are willing to treat it as an actual business, not a side hustle, and that means careful tenant screening, capital expenditure budgets, and documented systems, the returns can exceed stocks even without leverage doing the heavy lifting. If you use a strategy like house hacking, living in one unit while renting the others, you can reduce your own housing costs to near zero while building equity simultaneously. That is something the stock market cannot do. And the 131 exchange strategy, combined with depreciation, can allow a disciplined real estate investor to grow wealth in ways a brokerage account with no tax sheltering cannot replicate. Real estate is not a bad investment. It is a widely misunderstood one. Ryan and Devon both walked away from that decision, thinking they were making the smart play. Ryan believed real estate was the proven road to wealth. Devon believed the market would do the work for him. Neither of them actually sat down and mapped out what their chosen path costs in dollars, in time, in stress, and in risk across 10 or 20 years of real life. The real trap is not real estate. The real trap is not index funds. The real trap is choosing either one based on a thumbnail, a podcast clip, or something an uncle said at Thanksgiving, without ever wanting the complete numbers for your own situation, your own market, your own income, and your own willingness to spend a Saturday managing a plumbing problem instead of doing literally anything else. Here's the question you should be asking before you commit to either path. What does this cost me? Not just in dollars, but in every currency that matters. Because the answer that counts everything is the only answer that's honest. And if you want to see what happens when Ryan and Devon stop competing and start combining both strategies, owning property and investing in the market at the same time, the math changes in a way that most people are completely unprepared for. Drop a comment with what you're currently doing with your money. Real estate, index funds, both, or something else entirely. And I'll make the case for whichever combination most of you are sleeping on.